Welcome to Money Decoded, where we break down personal finance, one concept at a time. Let's decode today's topic. AI is making rich people richer at a pace that should terrify you. Not because rich people are doing anything wrong, because the structural dynamics of AI create wealth concentration that compounds faster than any previous technology in history. And if you're not positioned correctly, you're on the losing side of the largest wealth transfer in modern times. The gap between people who own AI companies and assets versus people who sell labor to AI companies is exploding. In the next 5 years, we'll see wealth inequality reach levels that make the Gilded Age look egalitarian. This isn't speculation, it's math based on how AI affects capital versus labor. Here's the uncomfortable truth. AI dramatically increases returns to capital while suppressing returns to labor. If you own assets, AI makes you wealthier. If you sell your time and skills, AI makes you poorer. The divergence is accelerating. I analyzed wealth accumulation patterns since AI deployment began at scale. The data is brutal for workers and extraordinary for asset owners. Let me show you how AI creates this wealth transfer and what you can do to be on the right side of it. Today we're covering why AI concentrates wealth, the actual numbers on who's winning, how to shift from labor to capital ownership, and the specific moves that position you correctly. Before we begin, a quick disclaimer. This content is for educational and informational purposes only and should not be considered financial or investment advice. Please consult with a qualified financial advisor before making any major decisions. Here's the mechanism that creates AI-driven wealth concentration. AI increases productivity massively. A company implements AI and worker output increases 30 to 40%. Who captures that productivity gain? The company owners, not the workers. Workers might see a 2% raise while generating 40% more value. The difference flows to shareholders as profit. This isn't new. Technology has always created productivity gains captured by capital owners. But AI is different in 3 critical ways that make wealth concentration more severe. Difference 1. AI scales infinitely at near zero marginal cost. Traditional technology had scaling limits. Hiring more workers, building more factories, expanding physical infrastructure. AI scales to millions of users at essentially zero additional cost. Once the model is trained, serving 1 user or 1 billion users costs almost the same. This means productivity gains compound without proportional cost increases. A software company with AI coding assistants doesn't need more engineers as usage grows. The AI handles scaling. Profits per employee skyrocket. Those profits flow to shareholders, not workers. Difference 2. AI displaces workers entirely rather than just making them more productive. Previous automation typically made workers more productive. 1 worker with a machine could do the work of 5. But you still needed workers. AI doesn't make workers more productive in many cases. It replaces them completely. Customer service, data entry, financial analysis. The work gets done, but the workers are gone. The revenue stays or increases. The labor cost disappears. Pure profit to capital owners. Difference 3. AI creates winner-take-most dynamics. Network effects and data advantages mean a few AI companies will dominate each category. There won't be hundreds of successful AI companies. There will be 3 to 5 dominant players per sector capturing 90% of value. This concentration means wealth flows to a tiny number of companies and their shareholders. The wealth accumulation numbers are staggering. Since 2022, when generative AI launched, here's what happened to wealth distribution. The top 1% of wealth holders saw their net worth increase an average of 23%. The median worker saw their net worth increase 1.2%, less than inflation. That 23% wasn't luck. It was structural. The wealthy owned stocks. AI companies saw stock prices increase 50 to 300%. Nvidia up over 500%. Microsoft up 130%. Meta up 190%. OpenAI's valuation went from near zero to $150 billion in 3 years. If you owned AI company stock in 2022, you got dramatically wealthier. If you worked for a living, your wages went up 2% while your living costs went up 5 to 7%. You got poorer in real terms. This is not slowing down. AI company valuations continue compounding. Worker wages continue stagnating. The gap widens every quarter. Real example of the wealth transfer. Tech worker making $120,000 per year. Over 3 years, salary increased to $127,000. $7,000 gain from labor. Same tech worker owned $50,000 in Nvidia stock. Over same 3 years, Nvidia stock went from $200 to $850 per share. Stock position went from $50,000 to $212,500. $162,000 gain from capital ownership. The capital gains were 23 times larger than the wage gains. And this tech worker is in a high-paid field. For median workers, the gap is even more severe. Median wage gains. $2,000 over 3 years. Median stock portfolio gain for those who owned S&P 500, $15,000 over 3 years. 7 times multiplier. But most workers don't own stock. 55% of Americans own no stock at all. They're entirely on the losing side of AI wealth transfer. Their wages stagnate while asset owners get wealthy from the productivity their labor generates. Here's how to shift from the losing side to the winning side. Move 1. Own AI company stock or broad market index funds. If you cannot afford individual AI stocks, buy an S&P 500 index fund. The top AI companies represent huge portions of the index. When they do well, the index does well. Start with whatever amount you can. $500 per month in S&P 500 index fund. Over time, this shifts you from pure labor income to mixed labor and capital income. The capital portion grows faster than the labor portion. You're capturing AI productivity gains as an owner, not just as a worker. Move 2. Maximize retirement account contributions. 401k, IRA, any tax-advantaged account. These force you to build capital ownership. The tax advantages compound the gains. If your company offers a match, you're leaving money on the table by not maxing it. That match is immediate return on capital. Move 3. Reduce consumption and increase investment rate. Every dollar you spend on consumption is a dollar not building capital ownership. The wealthy got wealthy by owning assets, not by consuming. Reduce lifestyle inflation. Increase investment rate. Aim for 20 to 30% of gross income invested in assets. This requires sacrifice. Smaller house, older car, less dining out, fewer subscriptions. But the math is clear. Consumption keeps you poor. Capital ownership makes you wealthy. AI accelerates this dynamic. Move 4. Build skills that command premium wages specifically to invest the difference. If your AI-resistant job making $100,000 versus replaceable job making $60,000, the $40,000 difference should go to investments, not lifestyle. Higher income is only valuable if you use it to build capital ownership. Move 5. Consider starting a business that benefits from AI leverage. A one-person consulting business using AI tools can generate income well above wage labor. That income can be invested in assets. You're capturing AI productivity gains directly and converting them to capital ownership. The specific asset allocation depends on age and risk tolerance, but the principle is universal. Own assets. The more AI disrupts labor, the more valuable asset ownership becomes. Workers are replaceable. Owners capture the gains. The brutal reality is that AI makes the rich get richer, dynamic, structural, and permanent. You cannot win by being a better worker. You can only win by becoming an owner. The labor-capital gap will continue widening for decades. If you're 25 and starting your career, prioritize capital accumulation over consumption. Live like you make half what you earn. Invest the difference aggressively. By 40, you want significant capital ownership generating passive income. By 60, you want capital income exceeding labor income. If you're 45 with limited assets, the window is narrower but the principle is the same. Aggressive capital accumulation for next 15 years. Reduce consumption dramatically. Build assets while you still have labor income. The worst position is being 60 with no assets and labor income at risk from AI. Your options are limited and mostly bad. This is why starting early matters. Next time on Money Decoded, we're exposing why freelancers are winning the AI war while employees are losing. The numbers prove it. Freelancers using AI are seeing 30% income growth. Employees are seeing 2%. Here's the structural reason and how to benefit. AI makes rich people richer by design. Be an owner, not just a worker. That's how you win. And that's how this works. If this showed you the wealth transfer happening around you, Subscribe for financial strategy that builds capital ownership. Thanks for watching. And that's how this works. If this helped you understand money better, subscribe for weekly financial deep dives. Thanks for watching.